Hi, this is Seth David from the world-famous Nerd Enterprises Incorporated, bringing to you another special screencast. This time we're talking about understanding your balance sheet, specifically the equity accounts. In order to explain this properly, I want to give you a very brief overview of the whole balance sheet, and then we'll stay focused on the equity accounts themselves. The balance sheet is made up essentially of three parts. We have assets. These are the things that you own or have rights to, the cash in your bank, accounts receivable, which are monies people owe you for products and services you've already delivered. These are things you have rights to either collect or to own. You have ownership rights to your assets. Next, we have liabilities. This is the opposite. These are liens on your business. These are obligations that you have to pay others, either for the products or services that they've delivered to you, or if a bank has loaned you money and you've promised to repay them. Those are liabilities or liens on your company. When I subtract liabilities from assets, I get the equity or the net worth of your business. And if you think about it from a very logical standpoint and using very much layman's terms, it makes sense that if I take all of my assets and liquidate them so I have all cash, and I use that to pay off any liabilities, the difference is what I'm left with, which is the true net worth. That's what my company is worth today, in a snapshot, a moment in time. So next we're going to take a look in QuickBooks and see what this looks like for a few different entity types. And by entity types I mean S Corp or LLC or sole proprietor. And we're going to look at how that impacts how we set up the accounts. And we're going to look at some transactions and see how those transactions specifically affect the equity section of our balance sheet. This is one of the most confusing parts of the financial statements for most people, especially if you don't have an accounting background. Okay, so we're going to look at understanding the balance sheet, the equity accounts, and what that looks like in QuickBooks. First, a quick shameless plug. Visit nerdenterprises.com for all the best in QuickBooks training and support, managed cash flow projections. There's a video that's related to the one you're looking at now, which I did a while back on contributed capital. I'll post the link. You're definitely going to want to check this video out if you're watching the one that you're watching now, because it's related, which is why I'm bringing it up, to help you, because I'm all about making it easy for you. So now let's go to QuickBooks and see what I'm talking about here. I think it's important to understand the equity accounts. I think it's especially important because I think a lot of people, especially those who do not have an accounting background, have difficulty understanding the equity section of the balance sheet, what it tells you, how it works, when you would post something there. Very often I get asked questions by owners of small businesses in terms of QuickBooks and how to post things that have to do with things that directly impact the equity section of the balance sheet. Now, the first thing that's important to understand is that the setup of your equity accounts in your chart of accounts, and I went here by going to lists and chart of accounts. The equity section is going to vary depending on the entity type. You have corporations and S Corps, which for those purposes are essentially going to be the same. Then you have your LLCs and your partnerships. So we're going to look at a couple because LLCs and partnerships are very similar in terms of how they get set up. So let's take a look at this for a second. Let's create some accounts here. And we'll go to New, and we're setting up an equity account. And first I'll create the parent account. We'll look at what this looks like for S Corps. So I'm just going to create an equity section on the chart of accounts called S Corps. I'll hit Save and New so I can quickly create shareholder contributions. Okay, and then I'll sub-account of S Corps, Save and New, shareholder distributions, sub-account of S Corps, Save and New. Now let's create the LLC accounts. LLC, we'll call it LLC/partner. Partnership. Save and New, and we'll just call this member capital. Save and New, member earnings. I like to call it sub-account of LLC partnership. Now save and close because we're done. So this gives you an idea of what the account structure looks like for the two different entity types that we're talking about here, really three, because LLCs and partnerships, the only difference here is you're going to change it from member capital to partner capital. That's the only thing that's going to change in terms of this setup here. So once we have the account set up, we can start looking at what kinds of transaction affect the equity section. Well, first of all, when we start a business, what often happens is by the time we've started, we've got we may not have a bank account open yet, but we may have already started to conduct transactions on behalf of the business. So we're paying for things personally. So let's say we bought some equipment. What we want to do to record that in the company file, where we've paid for the equipment out of our pockets rather than out of the business because we didn't have the bank account set up yet or whatever the reason, we're going to come over here to company, and you really just want to make a journal entry. So you're going to make general journal entries. Let's say we bought $5,000 worth of equipment there. Well, the first thing is, and this is where you have to understand a little bit about debits and credits, or you can just kind of memorize this, but assets, equipment is an asset. It's something you own, as I mentioned earlier in the video, or something I have rights to once I've purchased it. So that's an asset. So we're going to call this machinery and equipment, which I have already set up on the books as a fixed asset. The question is, what do I put here? Because normally if I was paying for it out of the business bank account, it'd be different. I'd simply be writing a check, right? And down here at the bottom of the check, I'd be booking it to machinery and equipment. But I didn't pay for it with a check from the company. I paid for it personally. So I'm booking it as a shareholder contribution, assuming it's an S Corp. And that's exactly what this is a shareholder contribution. So when I book this, and of course I should put a detailed memo on here explaining that I've paid for this personally. I'm not going to waste your time having you watch me type that out now, but I should put that on here and watch what happens to the balance sheet now when I hit save and close on this. Boom, there's my asset, machinery and equipment, and there it is in the form of a shareholder contribution. Because when I pay for something out of my own pocket, when I pay for it personally on behalf of the business, then it's me making a contribution into the business. I'm sidestepping one thing, because really the pure and clean way to have done this would have been to first put the cash into the business and then let the business pay for it directly. That's what I tell clients. I say, ideally, if you can afford to do that from a practical standpoint, that's always better, is put the money into the business, pay for it with the business. But that's not always practical, especially when you're starting up. Now, let's say now we've got the bank account open, and we want to fund the business with money so that the business can actually operate and start to conduct business. Well, now we're going to record a deposit into our bank account. So that's easy, because I record a deposit into iBank on the date that I've made the deposit, and again the account it's going to go to is your shareholder contributions. And let's say we put $10,000 into the business. I hit save and close, and look what happens to my balance sheet. Now the bank account shows up there with $10,000 in it. I've got my machinery and equipment, and I've got my shareholder contributions. Let's say now that I've done this, I want to repay myself the $5,000 that I actually originally paid for the machinery and equipment. And this could happen for a number of reasons. Maybe this $10,000 really came from several different shareholders. If that's the case, then we want to change the structure on the chart of accounts now, because now we need shareholder contribution and distribution accounts for each shareholder. You want to describe each shareholder separately in the equity section of the balance sheet. That's important, so you can track exactly who contributed what and who took out what. And of course the same thing applies for an LLC or partnership, where you have their member or partner capital accounts. It all has to be tracked separately. But now I could repay myself by writing a check to myself. We'll just call it to shareholder for $5,000. And now I want to take this one out of the shareholder distributions. Again, watch what happens to the balance sheet when I record this check. It comes out as a negative, because now I'm pulling money out of the company. I'm pulling equity out of the business. Let's record an invoice real quick, just so we could see what happens, because a lot of people, this is where a lot of people get tripped up. The profit and loss is what shows our income and expenses. But in order to close the books out at any given time, and again the balance sheet is a snapshot of a moment in time, in order to close the books out, we have to flow whatever the net income is for the period to the balance sheet, and that hits the equity account. If I've made a profit on my business, then that goes to increase the equity. I've increased the equity of my business. I've increased its worth because I've made a profit. I've made money. So let's record an invoice real quick so that we have some income on the books. And I'll just quickly set this up. I should have done it ahead of time. We'll just do a quick setup on the customer. Okay, and we'll do for the item, it doesn't matter, I can just do a service item. We'll quickly set that up. This is how, if you're really rushing to do things, you can actually do it very quickly. We'll add a new income account called services. Save. Okay. And let's say we did $5,000 in business, or let's use a different number so that it's not confusing. $7,000 in business. Save and close. Before I proceed, it wants to know if I want to take credit cards or any of that wonderful stuff. So notice now I have accounts receivable of $7,000. I mentioned this in the beginning. Receivables are an asset. It's something I own. I have the rights to collect that money. I also have net income of $7,000 because now I have a profit. I've recorded income. I have no expenses recorded yet. So that net income flows over to here. So this is how we always balance out, is really in the equity section by flowing the net income or loss over here. So now the total equity is $17,000. It's really the net of $10,000 that I've contributed plus $7,000 in net income that flows over to the balance sheet. Let's record a bill real quick. For rent, we'll pay the landlord. This is rent expense. We'll set that up on the books real quick. Save and close. Now I have accounts payable because I haven't paid it yet. So I've got accounts payable for $3,000. My net income just went down to $4,000. Let's run the P&L real quick so you can see exactly what this looks like. So you can see I'm not crazy. There's my income of $7,000 for the services, my rent of $3,000 for a net income of $4,000. The $4,000 flows over to the balance sheet right from here. That's exactly where this number comes from. It closes it out. Now, once you go around to January 1st, or the first day of the year, based on whatever fiscal year you've set up in QuickBooks, usually it's a calendar year unless you've set it up otherwise. Once you get past the last day of the year, QuickBooks does sort of a permanent closing entry, and it'll close this P&L, zero it all out, and you'll see a permanent flow through to the retained earnings account, which will show up in the balance sheet. You don't see retained earnings here yet because it's a new company file and it hasn't gotten past the first year yet. But once you do, you'll see that account is standard. It's required on every set of books that you have the retained earnings account. There it is. And for that matter, on January 1st, what I will usually do is post a closing entry, closing out all the other equity accounts and closing them out to retained earnings. Because at the end of the day, retained earnings is just that. It's the accumulation. It's a cumulative account. It's the accumulation of all the earnings that you've brought into the business, plus anything you've contributed, minus anything you've taken out. And the first thing that whoever is doing your tax return is going to do, or should do, when you submit your set of books to them for tax prep, is they should be looking to reconcile your retained earnings, looking at the last tax return that you filed, seeing what the retained earnings were on that tax return, and then comparing that with your set of books from that prior year to make sure that the retained earnings tie out. And then they're going to reconcile the retained earnings from the beginning of the year to the current retained earnings on your balance sheet to make sure that it all makes sense. They're going to take the starting retained earnings, they're going to add in whatever contributions you've made, whatever shareholder contributions there are, they're going to subtract any distributions, and they're going to make sure that that adds up to the ending retained earnings on your balance sheet. And if it doesn't, they will often kick it back, or you may not even be aware of it, but they'll be charging you for extra time to look into that and see why it's off and then fix it. And then they'll just shoot you back a series of adjustments to post, and you may be none the wiser that you've actually paid for time to have somebody correct this. So you can save yourself some money by understanding how this works and making sure that everything is in agreement with the prior year tax return before you submit it. This is a service I provide to clients, and they pay me, not as much as they'd pay their CPA, but they pay me to review their books and make sure that these kinds of things all agree. So if you have any questions about that or any of this, give me a call at 866-945-8070. I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web. Nerd Enterprises Incorporated offers consulting and training with QuickBooks, Excel, cash flow, and technology. Give us a call or visit us on the web, www.nerdenterprises.com, 866-945-8070.